Let's talk about how income taxes affect capital budgeting. Looks like these two little critters are sitting and ready to learn. Hopefully you are too. Income taxes in the United States are always a percentage of taxable income of the company. Tax laws differ from FASB rules, so the net income is not always the same as taxable income, but in many book problems we just kind of assume they are. In real life, it's very important that you really know the tax laws that affect your capital budgeting decision. Income taxes, though, are always a cash outflow, so what makes them complicated is, unlike the cash flow to buy an asset, for example, your income taxes change based on the revenues and the expenses of the project, so it makes it a little bit harder to compute. So how's that work in capital budgeting? It means that any cash flows that are on the income statement usually are also on the tax return, and so those will change the amount that you pay in income taxes. So if you have revenues of $10,000, you really don't get to keep all that. But on the other side, if you have expenses of $10,000, that saves you taxes, so you really don't have to pay all of that. So when we compute the cash flows, we always need the cash flows after taxes. So let's just do a quick little example. You've got a new project and it's going to have $15,000 in additional revenues, but it will require $30,000 in additional marketing costs. So you're trying to see if you should do this new marketing plan. The income tax rate is 30%. So our revenues are $50,000, the marketing expenses are $30,000, so the cash flow before taxes, we're going to net $20,000, but we'll have to pay taxes on that $20,000, so the government's going to take $6,000, leaving us with only $14,000. So that would be the cash flow after taxes you'd use in your capital budgeting decision. The shortcut to come to that, if you don't want to work your way all the way through the income statement, is your net cash flows, the 50 minus 30 or 20,000, times 1 minus the tax rate, or in this case 70%, is the amount you get to keep. In other words, the government takes 30%, you get to keep 70%. So that's all there is, other than you have to know that taxes matter, and for a lot of the cash flow decisions, these are one of the major cash outflows you have to worry about. So make sure you always use the net cash flows after taxes.